Welcome to the deep dive. Today, we're jumping into the world of a true investment giant, Warren Buffett.
That's right, and we're using excerpts from an audiobook, Sak Noi Phone Fop to Warren Buffett Chung One. It's based on Robert Hagstrom's book, The Warren Buffett Way.
Our mission here is pretty straightforward. Use this source to unpack Buffett's core ideas, his backstory.
And see what Hagstrom's take offers for your investment thinking. What can we actually learn from this specific material?
It's interesting how Hagstrom even got into writing it. The source says he was just, well, really impressed by Buffett.
Yeah, his clear writing style, apparently, and how calm he stayed when markets were going absolutely wild.
Right. And Hagstrom believed Buffett's systematic way of thinking wasn't just for billionaires.
Exactly. He thought individuals, smaller organizations, they could use it too.
The basic idea in the source is that the method itself
Mhm.
is fundamentally simple.
Mm-hmm. And it works, supposedly, whether you're buying, say, 10% of a company or just 100 shares.
But there's a big warning right at the start in this material.
Oh, yeah, definitely worth mentioning. It says, basically, don't compare your results to Buffett's. I mean, the guy has 50 years of experience.
50 years as an owner and investor.
Yeah.
It's unique.
Totally. So the advice is compare yourself to maybe your peers or, market indexes like the S&P 500.
That's a good grounding point. And this source material comes from an updated edition of the book, right? Covering the decade up to about 2004.
Yep. And Hagstrom added some important new stuff in that update.
Like what?
Well, two big things were chapters on focused investing. That's Buffett's portfolio management style, and crucially, the psychology of money.
Ah, the psychology part. That feels really important. The source seems to stress it.
It does, absolutely. Understanding money psychology helps you spot those emotional traps, the ones that make investors do, well, foolish things.
Right. So you can avoid them yourself.
Exactly. And maybe you can even see when others are falling into those traps, potentially find opportunities there.
Okay, let's dig into the main content then. First up, Hagstrom noticed a change in Buffett's actual activity. Late 90s, early 2000s. What was going on?
Well, during that time, the observation was a definite slowdown in his buying of public stocks, shares of companies on the stock exchange.
So less stock picking. What was he doing instead?
He was putting more emphasis on buying entire companies outright, private businesses, or taking control of public ones.
But he wasn't completely ignoring the public markets. The source mentions other things too.
No, not entirely. He'd still make moves, sometimes quite large ones, into things like corporate bonds or even government securities.
But he'd get out when they weren't so appealing anymore.
That's the idea presented, yeah. Exit when the value proposition faded.
Now, those private companies he bought, it's hard to analyze them from the outside, right? No public financials.
That's a key challenge the source acknowledges. But Hagstrom basically assumes Buffett must have seen something very attractive there, even if we can't see the numbers.
And this difficulty might be why those new chapters were added in the revised book, Focused Investing in Money Psychology.
Seems likely, yeah. To give more context, especially around the thinking process, since the private deals were less transparent.
Which brings us back to that psychology piece again. It really feels central.
It is. Hagstrom basically argues you have to understand the psychological side to invest like Buffett. You need to recognize those temptations that make you deviate from rational thinking.
It protects you from your own biases.
And it helps you maybe identify when the market itself is being irrational, driven by collective emotion. That can create openings.
Okay, think about that period the revised book covers, like 94 to '04, what a time, the tech boom, the bust.
Oh, absolutely. A huge amount of change, volatility, and just noise. Endless commentary, online forums popping up.
Definitely a tough time for investors to navigate.
For sure. But what's striking in the source is the argument that despite all that chaos, the fundamental principles of investing, the ones Buffett followed, didn't change at all.
And Buffett's advice during all that madness.
The source highlights his consistent message. Just stay away from the craziness, especially when it felt more like wild speculation than actual investing.
That sounds almost like doing nothing.
Well, the source frames it as a strategic move, a safe harbor, really, not necessarily inactive, but selective.
People always say, this time it's different, especially with new tech or wild markets. How does the source push back on that?
It tackles that head on. Look, markets change, economies evolve, industries transform, that's constant. But Hagstrom, interpreting Buffett, insists the core principles of valuing a business, those don't change.
So the environment shifts, but the underlying logic hold steady.
That's the argument. Which leads nicely into what the source calls the really simple goal of investing, pulling from a Buffett quote in a '96 report.
Simple goal. Investing often feels complicated. What is it?
According to this analysis of Buffett, it's almost shockingly straightforward. Buy shares in businesses you are certain will earn much, much more in the future, like 5, 10, even 20 times more.
Wow, that's a very high standard. Certainty and massive growth.
Extremely high. And the source is clear. Very few companies actually meet that standard. It's rare.
So the crucial takeaway then is, when you do find one,
You buy a lot, go big. That's the message. And it applies, the source suggests, whether you have a little or a lot of capital.
and opportunities like that always exist if you stick to the standard.
That's the belief presented. You just have to do the work to find them.
Okay, let's zoom out. Who is Warren Buffett? How did he become, arguably the greatest?
Well, the source points to his consistent ranking on the Forbes 400 list. But what's really unique, it argues, is how he got there.
Not through inventing something or inheriting wealth.
Exactly. It's purely from understanding investments. The source notes he was the only one in the top 5 wealthiest Americans at the time whose fortune came solely from mastering the stock market.
The numbers are just mind-boggling. Starts with $100 in 1956.
It's $25 million about 30 years later, and by mid-2004, the source pegs his net worth at roughly $42.9 billion.
With Berkshire shares trading around $92,900 each then.
Incredible. Just phenomenal growth, fueled by investment skill.
Let's go back to the start. His early life in Omaha, Nebraska. Born in 1930.
Yeah, his background seems relevant. Grandfather had a grocery store. Funny side note, Charlie Munger worked there as a kid. His father was a stockbroker.
So finance was in the air from early on.
Definitely. The source mentions him being fascinated by numbers super young, reading his dad's market books at age 8.
8 years old.
Yeah.
And watching the stock boards at 11.
Yeah, really precocious. He even had successful little businesses going and apparently wanted to skip college altogether.
But his dad said no.
Dad insisted, so he went to the University of Nebraska. But the real game changer, according to the source, was discovering a book.
Benjamin Graham's The Intelligent Investor.
That was it. It hit him so hard he applied to Columbia specifically to study under Graham.
And they clicked. The source mentions intellectual chemistry.
Apparently so, a deep connection. He even worked for Graham's firm, Graham Newman, for a couple of years after graduating. Really soaked up Graham's value investing methods.
Then Graham retired, the firm dissolved, and Buffett headed back to Omaha in 56. He's 25.
And that's when he launches Buffett Associates, Ltd., his first investment partnership. Started with his own $100, plus money from family and friends.
About $105,000 total to start, from 7 partners.
That's the figure in the source, and the structure was interesting.
How did the profit sharing work?
The partners got the first 6% return each year. Anything above that, the partners got 75% of the excess, and Buffett, as the general partner making the decisions, got the other 25%.
And the performance? The source makes it sound legendary.
It really was. Over 13 years, he compounded their money at 29.5% a year. Just blew away the Dow Jones index consistently.
Often beating it by 20 points or more.
Yeah.
Way past his goal of 10 points.
Yeah, even in years the Dow lost money, the partnership often made solid gains. Remarkable consistency.
And that office he moved to in 62, Kiewit Plaza. Still Berkshire's HQ today.
A little piece of history right there.
Yeah.
And during this partnership time, Hagstrom notes he started doing something new strategically.
Taking control positions, not just buying small stakes.
Exactly. In both public and private companies, which included, famously, his first buys of Berkshire Hathaway stock in 1962.
Which was just a struggling textile mill back then.
Right. And another key example from this era, highlighted in the source, is American Express in '63.
Ah, the salad oil scandal. That crushed the stock.
It did, cut the price almost in half, and Buffett saw an opportunity, applying Graham's thinking.
Which was?
Be decisive when a truly great company is selling way below its real worth, its intrinsic value, Graham's core idea.
And Buffett went big on Amex.
Huge. He committed 40% of the partnership's capital, about $13 million then. A massive bet.
And it paid off.
Big time. The source says the shares tripled in 2 years. Netted a $20 million profit, described as Graham-like, Buffett-like, classic value play.
By 65, the partnership assets hit $26 million. But just a few years later, in 69, he shut it down. Why?
The reason given in the source is that he felt the market had gotten too frothy, too speculative. He just couldn't find enough cheap, quality companies anymore.
So, opportunities dried up, in his view. What happened to the partners' money?
They got their shares back. Some took his advice and invested with Bill Ruane, an old classmate who started a fund. But Buffett and others rolled their winnings into Berkshire Hathaway.
And Buffett's personal share, $25 million, was enough to give him control of Berkshire.
Exactly. That was the transition point. End of the partnership, beginning of the Berkshire era as we know it.
The source also gives us a sense of Buffett the person through Hagstrom's eyes.
Yeah, it paints an interesting picture, not physically imposing, but seen as a genius, complex, yet also simple, direct, honest.
A mix of logic, intelligence, and humor.
That's the description. Values logic, hates foolishness, aims for simplicity.
And his annual reports,
Mm-hmm.
they're famous? What does the source say about them?
Oh, there's something else. Long, dense, text only, no pictures, but filled with amazing quotes like, May West one year, the Bible the next.
And incredibly honest.
That's the key. He talks openly about mistakes, weaknesses, not just successes, treats shareholders like true partners, like owners.
And under his control, Berkshire's performance. Well, the numbers speak for themselves.
Absolutely staggering. From 64 to 2004, the period the book covers, net worth went from $22 million to $69 billion.
Did he have a specific target for Berkshire's growth?
Yep. The stated goal, mentioned in the source, was to grow book value per share by 15% a year on average, beat the typical U.S. company.
And did he hit that 15% target?
He crushed it. Book value per share went from $19.64 to over $50,000 by 2004. That's a 22.2% compound annual return.
Wow. And the source adds a really important footnote to that number.
Yeah, this is key. Berkshire's 22.2% is after paying all taxes, including capital gains taxes when they sell stocks.
Whereas index returns like the S&P 500 are usually quoted before tax.
Exactly. That tax drag makes Berkshire's after-tax performance even more impressive compared to the typical pre-tax benchmark. It's a huge difference over time.
Okay, let's loop back to that slowdown in buying public stocks in the late 90s, early 2000s. Why did Hagstrom think that was happening?
Well, the source discusses a couple of theories. Maybe Buffett thought the market was peaking. Or maybe just nothing looked cheap enough.
It comes back to that idea of certainty at a discount.
Precisely. Certainty comes from being able to predict a company's economics. The more predictable, the more certain the valuation. He wants that predictability and a good price.
His long-term holdings kind of reflect that, don't they?
Yeah.
Companies with stable businesses.
They do. So the slowdown suggested he just wasn't finding enough companies that met both criteria, high certainty and a significant discount to intrinsic value.
Hagstrom even speculates he would have bought more Coke or Gillette if their prices were lower, like 20 times earnings.
Yeah, that's the kind of speculation in the source, suggesting valuation was the main hurdle for those kinds of stocks at that time.
And this connects to the circle of competence idea.
Right. Invest in what what you really understand deeply through research and experience. That's where the certainty comes from.
And it's harder to get that same certainty in, say, fast-changing tech sectors outside his circle.
That's the reasoning presented. It's difficult for him, given his process, to get comfortable enough with the long-term economics of businesses far outside his expertise.
So this created a dilemma for him back then.
Sort of. The reliable companies he knew well were too expensive by his standards. The potentially exciting newer companies were too uncertain for him.
Which explains the lack of huge stock buys during that specific window.
That's the analysis offered in the source, yes. It explains the relative quiet on the public stock front.
But he wasn't just sitting on his hands.
No way. Still active elsewhere. The source mentions him buying high-yield bonds in 2002, for example, when he saw value there, and warning about market fads.
Okay, let's wrap this up. What's Berkshire's overall strategy, according to the source, and what does it mean for, the individual investor listening?
Berkshire's #1 goal, as stated, is maximizing long-term returns. The preferred way is owning whole businesses directly diverse, cash-generating ones with high returns.
And option number 2.
Owning pieces of great businesses through buying their stocks publicly.
But buying whole companies became the main strategy as Berkshire got bigger.
Yes. 2 reasons given. 1, it became a better way to deploy huge amounts of capital effectively as stock prices rose.
And the second reason, more personal.
Yeah, the source suggests Buffett genuinely enjoys the relationships with the managers of the companies Berkshire owns, the operational side. It's different from being a passive shareholder where you might disagree with management decisions you can't control.
Right. Makes sense, but most of us can't buy whole companies.
Exactly. That's not realistic for individual investors. So the source lays out 2 main paths for you based on these principles.
That's one.
Invest with Berkshire, buy Berkshire Hathaway shares. You benefit indirectly from all those businesses they own and manage. Let them do the heavy lifting.
Empath 2.
Apply the method yourself. Do the hard work to expand your own circle of competence. Really study industries, business models.
Build your own certainty to find those rare, undervalued gems yourself.
That's the idea. It takes effort, diligence. But the source argues Buffett's core principles are sound and applicable.
Hagstrom clearly believes these ideas aren't just historical artifacts. They still work. They guide smart decisions and offer potential for careful investors to do well.
Yeah, the belief is that these fundamentals offer a real path, potentially even to outperform the market if you apply them rigorously.
So quite a journey we've taken through the source material. From Hagstrom's motivation, Buffett's early life, the partnership years.
Through key investments, Berkshire's incredible growth, his evolving strategy, and that consistent personality.
And the core message seems to be about sticking to simple, fundamental principles. Understand the business, be disciplined, ignore the noise.
Pretty much. That enduring power of rational, business-focused investing, even when everything around seems to be changing.
Well, thanks for joining us on this deep dive into Chapter 1 of the Warren Buffett Way via this audiobook source.
Yeah, it's been fascinating. And maybe a final thought for you to consider. Given how much Buffett stresses understanding a business inside and out, staying in that circle of competence, how can you focus your own learning right now? How can you build your own expertise to find those few truly great opportunities